Joining us now in the broader markets ahead of this hour's key CPI inflation report, Noah Blackstein, Senior Portfolio Manager at Dynamic Funds. Noah, are you a believer in this growth scare that we seem to have had?
I'm actually, I think the economy's okay. I think we've stabilized. Things aren't necessarily getting worse. I think the risks of a policy mistake, though, have only been heightened more recently. Look, if you look at the summary of economic projections by the Federal Reserve, you're looking at at unemployment of 4.3% and Fed funds 100 basis points lower in 2025. Well, we've already hit 4.3% unemployment. So rates are too high. So whether it's the largest move in volatility since the pandemic or the global financial crisis, whether it's these abrupt moves that are going on, I think the market is getting significantly more concerned about a policy mistake. You know, we've heard over the weekend one of the Fed governors talking about inflation coming down because of supply issues. That's not really true. I mean, there are at the margin, demand is being choked off by higher rates. So I think the market is getting more and more anxious around a policy mistake by the Federal Reserve and the need for rates certainly to be at least 100 basis points lower than where they sit today. So we believe the economy is fine, but the costs of mistakes are rising.
It sounds almost like, and I don't want to put words in your mouth, like you think we're like at an inflection point. Like right here, the Fed has a critical period of time in which to decide how restrictive they will remain in order for the economy to actually avoid that growth scare from materializing.
Well, we certainly got the growth scare with the employment numbers, and then later on the claims numbers kind of eased people's concerns a little bit. But you can see how reactive the markets are. So, and that can feed on itself, and so the Fed has to be. The Fed needs to move things along. Jerome Powell has already said that by the time inflation gets to 2%, it might be too late. Well, PCE annualized on a 3-month basis is running at 2.3%. So, I think for market participants, it's time to get this process along. The extra rate hikes in 2023 for insurance purposes were probably can be dialed back. And so, we're at this point where the economy is fine, things are stabilized. I think for a lot of companies, margins are better as prices have come down. But the risks of staying too high for too long and the impact on the labor market are as balanced, if a lot of, and the market might be even more sensitive to, than the idea that inflation will somehow come roaring back from the unique circumstances of the post-COVID era.
So we've got an economy that's sort of balancing at this point and can go either way. At the same time, you think that there's a lot of money on the sidelines that could come into the market, which would be a positive force, $8 trillion globally in money markets. And so how do you invest in that scenario?
I think there's some things you can control, some things you obviously can't control. But assuming the Fed doesn't make a mistake and we've begun the process of normalizing on rates, and that doesn't mean rates are going back to where they were during the pandemic or the zero bound. We're talking about, Fed funds probably getting around, if you look at where 10-year yields are around the 3.8 level and 2 years around the 3.9, it's going from 5.3 somewhere down to that level, maybe a little bit lower. You're still in an era of higher rates. But I think there's over $6 trillion in the U.S., $8 trillion globally in money market funds. That's not all going to go into the stock market. A lot of that will end up back in bank deposits where it kind of left. I think the secular drivers of AI are continuing and will have an enormous impact initially on productivity, but eventually on demand generation. And that secular opportunity is still in front of us. It's barely begun. And lastly, I think that, from when we look at AI and why sort of the U.S. dominates in that, I think it has a lot to do with the environment, the ability to create businesses, to keep capital, and on a regulation side, the least regulations. The United States celebrates innovation. Europe seems to celebrate regulation. And one of the things people don't talk a lot about in the markets that we think is important was the Chevron decision by the Supreme Court, which basically, where there's ambiguity in law and legislation, the regulatory agencies have filled the gap. That's come to an end. And so better legislation has to come out, and corporations can now challenge these rules that basically are legislation that are passed by regulatory bodies. That can go for judicial review, and companies can litigate that. We think that's very important for the regulatory environment, for making it easier to do business and making it easier for companies overall. So there's a lot of drivers, but the risks of a policy mistake from the central bank are certainly the costs are high. So we have to navigate through this. If we assume they do the right thing, then there's upside for sure. Certainly for the average stock as well.